premium is gone and the game is over. No.
Buffett
I don't
premium.
want to think about it. The Buffett premium. Right?
What are you guys talking about?
Berkshire Hathaway.
What about it? Yeah.
It's not exciting.
No. Never has been.
Well, that's actually, it was exciting. Early, look at the chart. It had its best, best
50 years ago.
Months. No. Like, when were those all-time highs? Those all earlier this year, right? April, May.
It's low volatility stock, though.
No, I know, but it's getting killed. So, that's not fun. Anyway, all right. I think we're live, so let's just start us up and see where that gets us. Right,
dude.
Run it. I can't take no loss. I don't even know what it costs. I hit the ground then it go off. Yeah, hit the ground then it go off. Yeah, I can't take no loss. I don't even know what it costs. Yeah, I hit the ground then it go off. Yeah, hit the ground then it go off. Yeah. Run it. Ooh, I really feel it's my time. Think it's my year. Yeah.
All right. Good morning, everybody. Happy Tuesday. This is the morning show. You know that by now. Spencer, that's JC, and Steve and Alfonso. What are we talking about today? We're talking about a little bit of Berkshire Hathaway, a little bit of Warren Buffett. I don't really know what we're going to talk about. It's always a surprise to me. I always have things that I think I can guess, but my guesses are almost always wrong. What I do know is we'll have Kenny Glick on the show. We'll have a new guest alert on the show, Rob Haugen, who is the CIO of River One Asset Management. They have an actively managed ETF. We're going to talk to them about just like the whole actively managed aspect of their job and trying to beat the market, because that's what we do as well. So our interests are aligned in that way. The ticker is RVER, by the way. So we'll have Rob on at 9. We'll have Dr. Phil Perlman on around 9:20 or so. And that'll take us to the open. Sound like a plan? Sound like a plan. Before I move on and bring on the guys, I'm going to drop the link in the chat for our next big special event tomorrow with JC and one Jeff Mackey. Link is in the chat. Jeff is going to unveil he's been working on these like portfolios and these indexes behind the scenes. Basically, what he's decided is that the XLY is shit. It sucks, right? The XLY sucks. And if you want to really know what's happening with the consumer and with consumer companies, you have to slice and dice the market in a completely different way. But Jeff has that way. So that's going to be tomorrow. He's going to talk about the winners and losers of the trade war as well. We're about to hear from every big retailer under the sun this week and next week. We got Home Depot, we got Lowe's, we got Walmart. I think Walmart is tomorrow or Thursday. I don't remember, but we got Home Depot coming up here. So we got a lot happening on the retail front. So it's a big week for Jeff. So that's tomorrow at 2:00. I just dropped the link in the chat. I'll throw it on the screen as well throughout the show today. That's what we got. That is the plan. Here we go. You guys ready? Drop me a like. Thank you.
Hey now.
Hey.
Dude, we got bears at the house. Like real actual bears.
Like your main
Black
house?
bears.
Dude, look, go to slide 3. Dude, we have real bears. Like I'm used to like perma bears and stuff like that. Like I'm good with those guys. But these are actual bears.
Oh yeah.
This is on the camera. We got bears, dude. I'm like such a city kid, so like I'm not trying to, but this is like real life. Like I hang out where that bear currently is right now. I hang out there all the time.
Is that your main living house?
No. This is the house we have over the lake.
Okay.
They've got bears up there.
Well, of course. It's the Poconos. Of course they do.
We get some in our neighborhood here in Naples.
You know that fun fact? You know that Spencer Israel went on his bachelor party where me and my family have a house now? Isn't that hilarious? So anyway, I got bears. So I just want to say, in the old days, it was the perma bears that I had to deal with. I would much rather deal with perma bears than actual bears.
Yeah. See, you
now,
thought you had it bad then.
Do they mess with stuff? Do you have to like lock your garbage cans and stuff or no?
Oh yeah, hell yeah, dude. You should see my garbage cans are like freaking, it's like a prison. Like there's no way you can get in or out of that garbage can, you know? But the problem is that tourists come, and they leave their garbage out, and the bears that come get it, and they make a mess. There's just shit everywhere, you know.
That's awesome.
Stupid tourists and their bachelor party is just messing shit up.
Stupid tourists.
Yeah.
All right. Listen, we got things going on. Strazza, remember how last year people were like yelling at me because Warren Buffett was raising all this cash, and people were like, and then we were buying stocks very aggressively. They're like, "Oh, Jay-Z, you think you're smarter than Warren Buffett? You think you're smarter than Warren Buffett, bro?" I'm like, "Oh my god."
There was a bear market in between.
When? Last year?
No, earlier this year. Like Warren Buffett
really
looked smart for a little bit.
All right, let's get to the markets. Why don't we just check the data, right? Why don't we do that? Let's go.
Okay. All right.
Steve Strazza, the common denominator we've seen so far this week is that it is the end of August, and the market is reminding us of that. In case you forgot, the Dow is doing nothing again today. 45,000. This is it's up about 100 points. S&P's little 0.0, Nasdaq 0.0. So just not a whole lot. You got the bond market up about 1/3% on the 30-year bond futures, 114. Crude oil down 1% at 62. Copper down 1/3%, 445. You got gold flat at 33.80. Silver up a smidge, 38 and change, with the volatility index still under 15, by the way. And in funny money land, you got Bitcoin 115,500, down about 750 points. Ethereum 4,300, even flat right now. You got Solana 182, pretty much flat on the day. With the total crypto market cap, Mr. Spencer Israel 3.85 trillion. But the common theme here, Steve Strazza, once again, it is August, back half August. There ain't nothing happening this morning in the futures market.
No, I'm trying to look for something to say.
Platinum and palladium are each up 1%. I mean, that's an interesting theme that continues to persist.
Even the dollar, really quiet out here. And like JC's saying, that's just summer stuff.
Yeah. Strazza, tell the folks about your hedge fund experiences. What is the parking lot indicator, right? They're all out in the Hamptons, out in Europe. Low man on the totem pole gets a better spot.
We used to joke you could get the good spots in July and August at work.
And where would they go? They would go to the Hamptons mostly?
I don't know. People probably go in different places, but a lot of popular stuff is just beach houses that are a drive away is the move for a lot of people.
I like that move.
Yeah.
Great move. Be able to drive. You don't have to get on a plane. I got like friends of mine be like, yo, and you included, you're like, hey, you should buy a place in St. Thomas, right? Where is it that you want me to buy a place?
I still believe that. We'll talk.
Dude, I have 3 kids. What the hell am I doing with a place in St. Thomas? I got to get in the car and drive there, dude.
Investment.
Are you kidding me? I buy liquid assets.
You just bought a house.
That's not an investment. It's a waste of money. But, it's for the family. That's not an investment. Trust me, I'd rather be in the Solana with you than the Solana I had to sell for the house.
Get in. I mean, we spoke. Are you coming on Twitter Spaces today?
Yeah, I'll be there.
We spoke last week, and so I was looking at the chart today. Literally bottomed the Sol ETH ratio as we were talking about it at 10 o'clock a.m. last Tuesday. I think I'm going to say it now. That was the bottom in the Sol ETH.
All right, made it low, and then it's gone sideways. So,
No.
No.
It popped about 10%, gave about 5 back. I get it. Not a big bounce. Okay.
Listen, I'm rooting for you. Again, I am here to root for you because if you're right, I'm making a lot of money. So I'm good. I'm good with that.
I'm just saying.
All right, can we talk about throw up slide 3? This is the chart that's making the rounds. This one coming from Sentiment Trader, Berkshire Hathaway.
Phil Blotsky says, JC, get involved with Sol. We got to put the pressure on them, guys.
I'm not in. I don't know what to tell you. I'm in other stuff.
And tell me about sentiment.
Though this isn't necessarily sentiment. This is from Sentiment Trader. This is the performance of Berkshire Hathaway relative to the S&P 500. One of the worst 90-day stretches of all time.
I'll bet every single one of these were great buying opportunities
for Berkshire Hathaway. Well,
I know.
considering Berkshire's at $1 trillion, yes,
Yeah.
obviously. But nevertheless, yeah, keep going down. We'll just go through them. So here you can see the performance since the beginning of Q2, just to kind of put things in perspective. These are all of the sectors on an equally weighted basis, including the NASDAQ 100 equally weighted, S&P 500 equally weighted. So you can
Wow.
see these
Spencer,
returns.
cover your eyes.
Look at that. So technology on an equally weighted basis of
Yeah.
22%, discretionary 15. The index is up,
I know
13% for
it's.
NASDAQ.
I know it's been bad. I'm well aware.
So this is just pretty spectacular. And again, this is just a good lesson, not to pick on Uncle Warren. That's not what we're here to do. Warren Buffett is he's an idol to me and Strazza and Spencer. We love Warren Buffett, Charlie Munger, the whole crew out there. Nothing but love, right? Yeah. I've always given nothing but love. This is just to state a very important point here that you can see this massive underperformance. Let me take you back a year. Go back and throw up the charts of the cash positions. I was being told by journalists, I was being told by anybody with a Twitter account that I was a fool for buying stocks if Warren Buffett was raising so much cash. I was a fool. Well, you think you're smarter than Warren Buffett, JC? Like, that's what I would get, because Warren Buffett was raising record cash. Now, when you compare the cash to the market capitalization, which our friends over at Ritholtz, throw that up. This is from Batnick and the team over there, showing Berkshire's total cash.
That's great.
Wasn't really that extreme, time elevated, but nevertheless. But the point is, don't make decisions on what Warren Buffett's doing with cash. He's not a timer. He's always told you that. That's silly. If you weren't buying stocks, you were a fool. Don't worry about what Warren Buffett's doing.
Also, they just bought, like, well, I said just in the last few quarters, 4 new stocks, and they spent billions of dollars. But unfortunately, they have billions and billions of dollars, so it wasn't that big a deal in the grand scheme of things. But it's still, they just cashed you dropped for a bill. You know what I mean? And they can do that.
They've made some good moves. They've made some bad moves recently. And JC's spot on. Like, I feel like we have this conversation every couple of months, guys. Like, they're playing a different game than everybody else. So to sit here and focus too much on the ins and outs, like what Uncle Warren's doing over at Berkshire, it's just not going to help most people. They're just compounding. They're just buying and waiting. Warren Buffett historically hasn't been a good person to follow into his investments. By the way, don't shoot the messenger.
Actually, when Warren Buffett historically is raising cash, it's a great time to be buying stocks historically. Go back and look.
It's always a good time to be buying stocks.
Oh my God. No, it's not.
So
no, it's not always a good time to be buying stocks. You're so full of shit.
It's usually
U.S. stocks. We have the data, sir.
Oh my God. Depends on your time frame, sure. Like every rolling 10-year period or whatever. Yes, I know. I got the data too. That's not the point.
You tend to be okay over time.
Depends on your time horizon, Strazza. Here's one that stood out for me. This one, slide 7 there. Come on. How does this one not stand out? Look at that. Look at that baby right there.
Great chart. Important chart.
How about that? If that's not the chart of the week, I mean, I don't know what is.
So this is risk on.
You want to know some fun facts?
Mm-hmm.
So, fun facts. In the first half of 2025, the equally weighted consumer discretionary was flat, right? So, on an equally weighted basis, consumer discretionary was flat in the first half of the year. On a market cap weighted basis, it was down 2.6% in the first half of the year. This is consumer discretionary. Since the beginning of the third quarter, discretionary is now up 7.5%. on an equally weighted basis and hitting new all-time highs. That, my friends, is literally the definition of sector rotation. Tell me I'm wrong.
No, it's great. It's healthy. It's healthy stuff.
Where's the cap weighted? Throw that one up. Where's that? When's that one? When moon for the market cap weighted? So this is Amazon, Tesla, Home Depot, Mickey D's.
It's when Tesla stops sucking. Really?
Yeah. I mean, not that Amazon is doing so great. Amazon's still kind of, still trying to dance there. I mean, it looks good, but yeah, Tesla's a big one.
Tesla's in a range here. If this thing can pop and resolve higher, head back to those old highs. XLY will be at new all-time highs.
I mean, Home Depot's had a nice move there with the homies, right? That's an extension of your, our trades. I'm in the Pulte.
That whole space continues to improve.
I mean, we've talked about this before. Tesla is pretty much a range bound stock and every year and a half, 2 years, it goes bananas. And then it goes back into a range and stays there for a year and a half or 2 years.
Spencer's so right. That's exactly what it is.
And then it goes bananas again. And then it's back in a range again. And that's what it does.
Yep. No, you're spot on. That's exactly right. Go back and look at the chart. It rips like faster than any stock ever. Consolidates for a few years. Everybody, forgets about it. Then it rips, record returns again, and then it consolidates for a few years. People forget about it, and then it rips again. Spencer's like spot on, and I think that pattern continues. Like what Spencer just said is so right, and I think that probably continues. It's hard to fight that trend. No, I like it.
Yeah, it's very rangy. Yeah. So ARK Invest just keeps buying hood shares. Another 123,000 shares today.
Dude, I remember the days when we would look at the ARK Invest buys and sells every single day because she was moving stocks, right, with her behavior, her activity. And they had to disclose it, right, because it's an ETF, right? So it's like it's new stuff every day. Actually, I'd be curious to talk to our guest about that because our guest today runs an actively managed fund. It's not that active. It's not as active as those ARK funds, I think, but it is still active. So, that was a wild time. And every day, they would report, buying and selling. They would sell a stock one day and buy it 2 days later, right? It was like,
the stocks would move on it. I know
they would always do, and they had the 5 funds, so it was like the 5 families. It was always doing something. But anyway,
slow news day. Upgrade for Rocket.
It's super slow out there. Yeah,
Pfizer's got some vaccine news.
We are firmly in those summer doldrums. I mean, there's earnings, right? And like I mentioned, we have
VT's up 7%.
There was the Intel news. I saw a thing about Intel ripping this morning. I don't know I think ripping is probably a strong word. I think last I saw was up 5%, which I guess is ripping for Intel.
Are you kidding me? That is the banana zone for Intel.
All right,
that whole situation's crazy.
Yeah. The nationalization of Intel, apparently.
That whole situation is like what? You got the Ukraine stuff going. Yeah, the Russia, now the Ukraine. I don't know about this Zelensky guy. Do we have a wolf chart? The Bitcoin miners, really, we have to talk about them. They keep getting money. They're getting bankrolled by big tech, at least the ones that are doing compute center or data center stuff. Are you guys seeing this? Every week, there's another one popping. The news
just came out on the Under the Hood report.
This week's news is Wolf and Google.
That I did not.
They're just going to buy these guys. The big techs, they're just going to slowly gobble these things up.
Why wouldn't they?
They're too small not to just buy.
So this one came from Under the Hood.
Yeah. This chart, this has been one of the better ones. Took a break this year, and now it's like right back at it. I think this goes many multiples higher. What's happening is they're getting bought out, and it's ruining some of the upside. I think like this CORZ, this thing was ready to go, it was ready to run. Got bought out. I don't know what's wrong with the shareholders over there. I would have demanded a higher price. I don't know why they accepted it. APLD breaking out of a monster base. BTDR looks fantastic.
Throw up the Pony AI. Throw up the new slide 3 there. Look at that one. Yup. Lucas in the chat talking about Pony AI. Yup. Throw that one up there.
They love the Pony Boy.
Yeah.
A lot of the guys in the analyst team love the Pony Boy.
You call him the Pony Boy?
Toyota Motors loves the Pony Boy. Big investment. Yeah.
Listen, there seems to be a lot going on.
Hut looks great, Harminder. Yeah.
Throw up slide 11 there. Throw up slide 11. There seems to be a lot of positives, a lot of upside resolutions out of bases, sector rotation. Seems to be like healthy market environments. We just got new all-time highs in the Dow on Friday. First new all-time high since the end of last year. So first new all-time high weekly close of the year. NASDAQ 100 new all-time highs. S&P 500 new all-time highs, right? Highest levels ever. Meanwhile, looking at individual investors, There are more bears than bulls for 2 weeks in a row. 2 weeks in a row, more bears than bulls. How is that even possible? I don't understand.
Yeah,
I
just who are these
I wish
it's crazy.
the survey is fine, but I wish, and maybe it does. I guess I don't know. I wish it came with some explanations, right, or some summaries.
Like, what is it that you could possibly be so angry about?
I want to hear some. I want to see some actual responses, not the response data, some individual responses. You know, when they ask
hold on. So
why.
let's show what's happening here. So at the top, you're seeing the
see.
red and the green at the top. This is the most recent data showing, you know, what is that? 46% bears, 29% bulls. You know, last week it was 43% bears, 34% bulls. So more bears than bulls. And you can see some of the historical averages down below. You know, far more. You know, 50% more bears than average. I mean, this is on another level of pessimism. So, you know, gotta tell you, I'm happy to see it. You know, so many angry people. I mean, isn't it great?
Do we make this or do they make this?
They make this. This is a screenshot of their website.
They should show the 1 year lows too.
They show 1 year bearish high right there.
Yeah, I know, but I want to see the 1 year low.
What do you mean the 1 year low?
1 year low. And
bears, you're
like,
saying?
Is this a low? Is this a like 52-week low and percent bullish?
No.
What has happened? Nothing's happened in the last 2 weeks. Oh no, we had the inflation print.
I don't know about things happening, but the stock market's making new all-time highs, and people are angry as ever. I mean, it's fantastic.
No, but usually this can be traced back to headlines. Typically, I feel like, right? But there hasn't been.
What headlines?
That's what I'm asking, right? So we have the inflation
There's
print.
plenty of bad headlines still.
Like what?
Yeah. You got the trade war stuff. You got
now the unemployment. Here comes the unemployment. Yeah. Everyone's losing their jobs.
Yeah, some real estate situations. You got economy
consumer
stuff.
Discretionary making all-time highs on an equally weighted basis, bro.
I don't know.
And people are talking about recessions.
Out here talking about recessions.
Well, I mean, we do have Kenny in the house.
Not a game.
Yeah, right. Kenny's bearish. He's a bullish bear, right?
Who's a bullish bear?
Kenny. And
Kenny's a day trader. It doesn't matter what the stock market's doing.
Yeah,
right.
That's true.
Yeah, Kenny couldn't care less. He likes saying that he's a bear, but it doesn't matter to what he's doing.
He does like saying that. That is true. Anyway.
What happened to this Viking? This is earnings. You know what the moral of the story is? Just stay away. Stay away from these drugs.
Dude, that's what I've been saying.
Stay away from all of it. Just stay away.
Right? They have an obesity drug, apparently.
Yeah, I know. I know what it is.
Yeah, phase
Talking
2.
about all the GLP ones. Stay away. You don't have to be in there. You don't have to be involved. You don't have to do that.
The other thing with these biotechs and their headlines is, except for rare occasions, the headline is almost always positive, right?
Stocks down 34%.
I know, but the headline is always spun in a positive way. So you can't even trust the headline. You have to actually wait for someone to interpret the rest of the release. Oh, it came in below the data was below expectations or whatever, and missed the primary endpoint, whatever. The headline is always positive. Like the headline this morning for Viking reads positive, right? They announced positive top line results for a phase 2 trial, right? But the stock is down 35%. So what's so positive about that? I ask you. You have to know the story. So A, there's a bomb coming. You never know when that's coming. And B, you have to actually know the story.
Isn't there a meteor coming too? I heard there's a meteor coming. You hear that one?
There's always.
Wasn't JC hating on equally weighted semis yesterday? Yes. Not so much hating, but just not giving it a lot of weight because of the reasons that I said. And one of the things that I actually said was that in consumer, I look at it completely different. I actually, weight the equally weighted heavier in my analysis. How do you feel after that conversation yesterday, Strazza? How are you feeling about the difference between the equally weighted in the semis versus consumers?
I feel the same way. And I think it's probably a very similar situation there.
Nah.
They're both good. What do you mean no?
I mean, to your point, Mackie says that all he needs is Walmart. Like if he's stuck on an island and he wants to know how the world's going, how the U.S. consumer's doing, all he needs is, he said, the Walmart annual report. That's it. He says that's all he needs.
The fun facts about semiconductors that you shared with everyone yesterday weren't just about semiconductors. That's just the state of the U.S. stock market. There's a serious cap-weighted situation and a lot of concentration here, period. It's just how it is.
Not
and
in
it's only going to
industrials.
increase.
Not in industrials.
Everything to a degree. Dude, they're coming out, the asset managers are coming out and having to institute like new capping policies because it's never been like this.
It's a scary thought. It's a scary thought.
Well, first of all, it has been like this because
it
it was
is,
like this
but it's
before, and they had to
different.
they had to take stocks out of the technology index and invent new indexes to put them into. Like
They're
we've
gonna
already
keep
like
doing
this
that.
is not like something new.
It's going to keep happening. Eventually, there's not going to be a technology sector because technology is everything. Technology will be a part of every sector. So you're going to have to pick a new home. And
I mean,
and
Uber,
I really think
Uber's a transportation stock. It's in the
Right.
industrial sector. There's
Software.
nothing tech about it. By the way, it's one of the best looking trannies in the whole
This
list.
goes to the idea that Jeff was saying, which is like basically the modern classification system is outdated and stale. And if you actually want to understand what's happening, and you guys do this too, you make your own indexes, right? Because you can't
This is a great
rely on the GICs or whatever classification system you use, because trying to fit square pegs into round holes all day, and it doesn't quite work.
And frankly, it's a good exercise because doing it forces you to get to know the different stocks and the constituents of these indexes that we're looking at all day. And then that allows you to analyze the market internals and the message of the market better, more accurately.
Yeah. All right. We have Kenny in the house. Can we bring him out? And then we'll bring on.
Bring him out. Bring him out.
It's been a long time coming. They ain't cuffing my clock, they tugging. Putting up numbers, 99 problems, and I still kept it 100. Hola. Yeah.
Strazza! Got a banger going this morning. I'm trying to get like a traders only set list. Play at your own risk. What's up, 82 Disco in the house?
That's a little freestyle. That's a little freestyle action, a little breakdance music.
Hey, nice shirt, Kenny. Nice shirt, Kenny.
Thank you.
That's a great shirt.
It is. I've got them all. What's going on?
I don't know. You tell us what's going on.
How much is Thinkorswim paying us for that hat sponsorship there? They better be paying us big bucks.
TD Ameritrade. That's not a real company.
Cool, man. This is like, you can't even find this hat anymore. It's VIP.
Dude, nothing but love for TD Ameritrade. They overpaid the crap out of me for a long time to consult for them, and appreciate that, guys. I did the best I could. I try to help them. I don't think implemented any of my suggestions, but
right. Hey, I've been talking to a company for 11 years now to try to get multiple time frame on their VWAP, and they still can't figure it out. Shout out Trade Zero. Maybe one day we'll figure it out.
Kenny, Jesus Christ.
This is where we're just like. For the record, I still use Thinkorswim. I have my watch list is so old. There are still 4 Qs on the. That's how old this watch list is. I still use it.
We call them the cubes.
There are 4 Qs. 4 Q.
All right. Yeah, I think we all use TOS here. Anyway, Kenny, what's on the watch list today?
Well, that streak of 1,077 in a row. Now it's 1,078. Home Depot, baby. Let me show it to you. So this trade that I keep saying that I think you maybe think I'm joking around now, but if you remember, the streak started, we were under 1,000. Now we're up to 1,078. Home Depot. So again, you know it, you love it. Old school trading. Look at that smash on the earnings release, right? And then you get your little faux show bro action. So under the VWAP, today's VWAP, prior day VWAP. And if you get over the today's VWAP, back over prior day VWAP on an earnings report after you fake them out and shake them out, every single time this year, you've got to follow through trade. So even if you came in late and you bought this thing closing above 398, you still got your 5.5 points so far on this trade. And it's fan-freaking-tastic. And of course, there's this one. Remember, open, this thing does not want to die, and it just keeps coming back. So it woke up a couple of days ago. We got it on the radar, and this morning, little faux show bro action right there. As soon as I woke up, this was the first trade I took so far. I missed the Home Depot because I really wasn't paying attention, but wonderful trade here on the open. And there's always motion in the ocean. There's always something going on. You guys know about this one, LASC. This one, very bizarre because they were running commercials on CNBC, the shadiest possible commercials. Like when you see those just buy our stock. It's on the bulletin boards. And this thing actually took off, and it's been on the radar for a while. And again, little faux show bro action down there, that got this thing going. And then again, right here, I was just, enjoying this move a little while ago. And that's it so far. But, as far as the earnings are concerned, that Viking is going to be in play today. VKTX, I think, not earnings, but I think it's a drug release, right?
Yeah.
Negative.
Didn't work out too well for those shareholders, down 34% this morning. But if it breaks, let me guess, if it breaks above the today's VWAP, it's a go to the 2-day VWAP, and then from there it could really, really go to the open.
All of what you just said, and what's even nicer, let's call it the Andy Dufresne is forming. So the Andy Dufresne is once the stock crashes. And again, I heard you telling me I'm not just a day trader. I've been doing this 30 years. These patterns work on
JC.
Too.
No, what I meant to say is that you don't give a damn if we're in a bull market or a bear market.
It's true. I love a bull market or a bear market. And listen,
that's all I meant. Nothing but respect to the grandfather of day trading.
The faux show bro, I'll have to admit, works better in the bull market. But I'll show you the.
Does it?
Yeah.
Is that true? You don't get the fades in the bears?
Well, you got the faux show bro, and you got the short covering. Usually is going to be working better in the rip your face off rally that we're in right now. But speaking of this Viking, I stalk this now as a buy because you're setting up. You got one butt cheek for the Kardashian bottom, and now you're Andy Dufresne. So it's the combination, the sideways action, and then you get that a test of the VWAP. There you got one butt cheek from Kardashian. It's forming the other one. So now if it comes out of the Andy Dufresne over the Kardashian butt,
can you explain, Kenny, for the unknown, for the folks at home who might not be familiar with said Andy Dufresne pattern, can you explain what that is? I think that would be really helpful to maybe some of the people who are new here.
Let me show it to you on a longer time scale. I started calling it the Andy Dufresne when I bought AMD back in the day. I'm talking.
And can you explain who Andy Dufresne is? He did not play for the Mets.
Oh my God, Andy Dufresne. Andy Dufresne is from the movie Shawshank Redemption. So Andy, and again, the AMD trade was even better looking than this. Here, there it is. So when AMD crashed down from being a real stock from back in the 90s, and it went dormant. So Andy Dufresne has to whittle his way through that sewer pipe to make his way out to freedom. And then he runs to say what to Nayo and hangs out with Morgan Freeman on the island. So when a stock goes dormant, it basically is going sideways. And then I use these longer term time frames on VWAP. So the more it stays in the Andy Dufresne pipe and then comes out, he runs for freedom. And obviously you all know what happened to AMD when it came out of that, bottoming pattern. It wound up going up 10x. So it works on a daily.
It's off the chart. It can't even.
Literally off the charts, right? So it works on a daily basis too. So when you see a stock going, that's getting smashed intraday, it's the same concept. So stretch this chart out a little bit, and you'll see it better. Oop, hang on, and we're blowing up charts. There it is. So the sideways action again. That's washing all the sellers out. You don't know it's going to happen, but we wait to see it turn, and then we buy it. I heard you better buy stocks when they're going up and sell them when they're going down. So you want to see something here. Here's the opposite of it. So WULF, as we were shorting it live with our friends at 12 o'clock, and please watch the show today. I do a midday show every day, just doing a recap of what we did in the morning. This stock, I've been looking to short it because, again, that's where my bearish nature comes in. You see a stock that goes 100% in 2 or 3 days, I'm looking to smash the thing back at least 20%. So I don't short stocks while they're going up. Not a good thing to do. But once it starts having some trouble staying above VWAP, then you could identify your risk. And we were shorting it right here at $10.11, just using the 17 and the 21. And you see how it never really came back. And we just stayed short pretty much the whole day. And it turned out to be a pretty good trade. So the fake out, shake out, instead of, you want to see something, here's a nice trick. Put a minus sign in front of your stock pick, right? Minus WULF, right? Now you'll see it as if it was a bullish trade because most people don't see selling. So there you go. There's the fake.
So this is the chart upside down.
This is the chart upside down. So there's the faux, there's the show, there's your VWAP consolidation, and there's your breakout. So if you don't see it as a bear, just flip the chart over. It's
a neat trick.
Great advice. Yeah. Great advice. And first of all, that's not a new trick. That is one of the most old school methods ever that the grandfather of day trading here is implementing and showing you. That is one of the most old school tricks ever. They've been doing this for a zillion years. All the old school technicians do it. I do it myself. kudos to Kenny for implementing that on his own time horizon. Good job.
Yeah, and just if you didn't know, just put a minus sign behind on the.
Yes.
I've learned things all the time. You know what I learned? That you could go back and look at an option contract on Thinkorswim by just changing the date in the QSIP. I learned that 2 weeks ago, so I'm still learning things.
Nice.
Yeah. All right, so far so good. You know, a decent morning, and I am keeping an eye on this wolf. And by the way, NVAX has been in play. That one's also on our watch list. And then let me just give you a couple more that I'm looking at. We had a decent list today. Hold on a second.
Yeah, give us one more, Kenny, and then you can hop.
What was it? Well,
I like that NVAX. Good move there.
Kenny, I know Kenny's doing the Ethzilla. That's what you're watching.
Oh, you got Pan W.
Okay. Never
All
mind.
right. So again, this is where my bearishness gets me in trouble. I don't like this industry. I think all cybersecurity companies are scams. They're the ones who put the viruses out there, and then they come to the rescue. Hey, look at us. We can solve your problem. Yeah, you started the problem. I hate these stocks. I hate Pan W. I hate CyberArk. I hated FEEYE. I hate all these stocks.
Tell me how you really feel, Kenny. Tell me how you really feel.
It right here is a defined trade. You got 189.75 yesterday's aftermarket highs, and look at this. Boom, 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 bang, bang, bang. It does not want to break that price. You roll over breaking VWAP. I'm shorting this thing, and hopefully it gets down about 3 or 4 points. And if it breaks 185, you look for it to retrace just right back to that 183 level, and that'll be our day's pay. Limited risk here on the short, so didn't put it on yet, but I will be putting it on.
I love how you say that. Just make a day's pay. Absolutely love that.
Thank you.
All right. Thank you very much, Kenny.
Adios, Kenny.
Hit thebid.com, guys. He's there all day. He'll be going live on the channel at noon, Stock Market TV, and on YouTube. Okay, let's bring on today's guest. New guest, like I said, we're talking to Rob Haugen, the CIO of River One Asset Management. They've got an actively managed fund. I think we should probably talk to more of these actively managed fund managers because what they do and what we do is very similar, right? It's all about looking for outperformance, looking for alpha. So let's bring them out, and we'll see what happens.
Jay, we've been friends for a long time. Make the call.
I mean, this is pretty professional, guys.
Nice show you got going here.
Good morning. How you doing?
How we doing? Oh wait,
we're great.
Let's flip the camera around there. There we go.
Like that, okay.
All right. So, talk to us quickly. Just give us the overview of the strategy of what you're working on, and then we can kind of go from there.
Sure. River One, ticker's RVER. That's our first ETF. Born out of family office, active management. My partner, Tony, and I spent a lot of time moving money for the biggest hedge funds, biggest mutual funds in the world, learning a lot of what they did wrong, what was wrong with fund structure in general, and why it was difficult to beat the S&P, and why so many people were ripping money out, trillions out of mutual funds and putting it into passive ETFs, which is something that obviously we all understand why we use them and why they're effective. And we have no issue with investing in them, and we do here at the family office as well. But active ETFs are probably going to be in their heyday for the next decade. So that's what we wanted to create here. We wanted to create something that had the structure that could actually beat the S&P 500 over the long run.
Why? What were the problems that you were seeing?
Yeah, so a lot of it is how they construct, right? So one of the issues is the 9-box problem. So each of these active managers are fitting themselves into one box in particular: small cap value, large cap growth, what have you, and then being compared back to the S&P 500 as something they needed to beat, right? And they have their heydays, but all of these different fund structures have their down moments too. And especially now, especially value is really, has been terrible for 10 years, really can't beat the S&P or hasn't been able to, no matter how you've constructed it in the value world, right? So that kind of thing that can run against you and make it very difficult for an investor who's looking at their portfolio thinking, why am I in this active fund paying a higher fee when he can't beat the S&P or she can't beat the S&P, right? So some of that is structure like that. Some of it is over diversification, right? The mutual funds of the world, the ones that we work for, had 100 to 150 stocks in all of their funds. It made it really, really difficult to beat the S&P because there was no concentration weighting. We're 15 to 20 stocks, making sure that we pick the very best of them, and then weighting even our best picks, 10, 12, maybe even 15% within the fund. That's necessary mathematically to beat the S&P 500 over time. If you don't have the ability to do that, it becomes very, very difficult to beat the S&P.
How active are you? Are you like Kathy Wood active, like seemingly every single day buying and selling? Or Are these more like swing positions, or are there no rules like that, and you let the market dictate?
Yeah, we trade almost every day, but not every day. Essentially, there are names that I think that we like in the portfolio as secular growers that we may own most of the time for a couple of years. But there are definitely names that we take into the portfolio thinking the next 2 to 3 months are going to be certainly a great time. And when they realize, we eliminate them, we lower them. And so we'll give you a good example. We bought URI, United Rentals, just a little bit below 800. Obviously, this industrial electrical revolution was working its way down to these new particular names. United Rentals is something that's building out these data centers, right? And we could just see that the quarter was probably going to set up really well. Bought it just under 800, sold it just over $900. It's a name that we like in the long run, but we just don't think it's going to outperform the next 3 to 6 months the way that it did. So why not eliminate that name and put it into something else that we think will outperform for the next 3 to 6 months?
Why do you think actively managed funds are going to have their heyday? Because we've talked about this on our show with other guests as well. Obviously, we're living in a bit of a, we're living in a market cap passive fund world right now, and active. We've seen this explosion in the last, I guess you could say, couple of years of all these new strategies which are using leverage or defined outcome or active funds. Why do you think that they're going to have their moment?
Well, first of all, usually in investing, this is more of a trope, but where money has gone, you want to not be. Where money is going is where you want to be, right? And so all of these trillions of dollars that have gone to passive, we think have created a real opportunity for active managers, mostly because a lot of them are not looking at fundamentals whatsoever, right? And they're not looking at valuation whatsoever. And there's really not a lot that are making the combination between the two. There's a lot of good growth funds out there, or passive funds that are staring at growth and trying to make sure that they get that right. The value investors have lost capital, and there aren't a lot of people that are putting it together. The few that put it together, that understand that you're throwing away, that the passive investments are throwing away this company at this price, or they're underperforming or underbuying this at this price, and then a catalyst happens, the rotation will happen, and you, the active investor, will be in those names. I'll give you an example where that's happening right now. Healthcare stocks were thrown away over the last 6 to 9 months, really, really cheap, really, really not well thought of by passive investing. This United Healthcare, this Warren Buffett purchase has flipped that on its head. We were very overweight healthcare because on a value basis, that's performed really well, especially over the last 5 or so days.
To be clear, is this a value fund?
No, it's a growth at a reasonable price fund, because I don't think that you can make money in a value fund when the passive investors are attacking growth at the rate they are. And also, value funds tend to end up with tend to end up with bad companies. There's so much in value investing where you say AT&T is trading at an 8 PE, should trade at a 10 PE or what have you. There's not going to be a realization by passive in that world. They are attacking growth. They are attacking share takers, and you want to play in that game with them instead of against them over the long run.
Yeah. It's not the passive investors' fault that their money is going to the biggest names, because that's the nature of the beast, right? So, it's just sort of that's kind of how it works. So I'm curious about like your entry and exit signals. What do you use? You mentioned being fundamentally driven and growth at a reasonable price, but what do you use as your signal to get in? And you mentioned the URI to get out at 900, for example.
Yeah, so we do judge fundamentally, and we create a stock price based off of our own fundamental analysis. And we don't even look at the stock price of where it's trading before we create that. And then obviously we run a spreadsheet of calculated numbers against that, and we try to find names that pop out that look like they're trading far cheaper than they should. And the way that we do that differently is we don't necessarily say on a value basis that a 10 PE is cheap and a 30 PE is expensive. What we do is we try to assign a proper valuation, PE and otherwise, to a company based on their growth rate and based on the projections of that company and the projections of that industry, right? So Uber does not deserve a 20 PE because the market deserves a 20E. Uber is a bit better and different company. Uber could become a $1 trillion company one day if transportation moves in a certain direction. And so we will assign our own valuations and then see what pops out as to having a lot of value. And then what triggers a trade is if it's deeply below that value, that puts it on our watch list. But what really triggers a trade is that we can see a catalyst of money moving into that name. And that may be an earnings, that may be short interest covering for some reason or another, or it may be some sort of catalyst that they have coming on fundamentally in the stock.
I've noticed this phenomenon in the last couple of years where mostly just on the internet and stuff, of people treating PE as if it's like the holy grail, as if it is the end all be all, right? And not as if it's just one in hundreds of indicators that you can come up with, and it's not even, and it's also frankly deeply flawed, right?
Yeah.
It has its uses, sure, but it is not the holy grail. It is not everything.
It is not. PE will lie to you. PE lies in many, many cases, right? So what we look at is all the fundamental valuation metrics that you should look at, right? So we look at EV to EBITDA, net income to EBITDA. We look at free cash flow production, right? Because each one of those individually can lie to you. And if you use that as your valuation metric, you are lied to about how good the company is, right? So UPS is a great example, has a very low PE, is not a terrific company because there is so much CapEx required in that business, trucks and airplanes and all of the expensive stuff, that you need to go down to the free cash flow line and figure out how much money is UPS really producing as a company and judge that based on its valuation. And if that is not cheap, then who cares what the PE is? The free cash flow production is important in that business and in a lot of businesses.
So what is a typical time horizon for you?
6 months, give or take. But like I said, we'll hold certain things for 3 or 4 years, and or maybe something just through an earnings or through a catalyst cycle.
I'm curious about the management of an actively managed fund. I would imagine it's just constant reassessing of what you own, right? Pretty much all the time.
It is constant, right? And the weightings within there, right? And so if you have a stock, and this, like I said, this is the greatest time for active management, in my opinion, that we've ever had, right? Because there are individual stocks that in a stock market will go up 5 or 10%. We have individual names that'll go up 30 or 40% because they become in favor, essentially. That's the outperformance that we're getting there. But when you buy a stock, we own SoFi at $10, right? And it goes to 22, right? And you're up 100% in the name. You have to reassess whether it is now still a growth at a reasonable price stock. Now, if SoFi grew, it can still be in the portfolio because it's a growth at it's still at a reasonable price by our estimation. If SoFi showed no sign of growth and just grabbed 100% in its valuation, then it does no longer fits our model and we've got to remove it. And so every name as it moves specifically, we are definitely reassessing both whether it should be in the portfolio, whether it's going to outperform the S&P, or whether it should be taken out.
Do you put any thought into the weightings, overweight, underweight, certain sectors, markets, industry groups, or not really?
We do a little bit, right? There are certain ones we avoid. I think the folks before us talked a little bit about biotech and how hard that is. We are not doctors. We don't pretend to be doctors, and so we just avoid. So there's just a few subsectors that we typically throw out, biotech being one of them. But then within the subsectors, we do the stuff that JC and his team are doing that's showing valuation of sectors and why a sector is important or not. We want to be where the money is going to go, right? And so many ETF buyers these days are thematic in what they're doing. And so as they're jumping on themes, we want to be in names within those themes as long as the price of those stocks are reasonable, are affordable, right? And so where the money is going, the sector is something that we are very interested in, especially as it makes a turn.
So what are some names in the fund? You mentioned Uber, you mentioned UNH. What are some names in the fund now?
No, neither of those are in the fund right now.
Okay.
We don't think they're outperformer right now, but we are a big believer in Google. Google is probably the only Mangman that fits the growth at a reasonable price just because of the reasonable price piece. All of the other Mangmans, they're growthy stocks. They're terrific companies, but the only one that we have in mass, only Mangman that we have in mass.
I've never heard of Mangman. Is that the new acronym? Is that just
Fang Man, the Magnificent
Oh yeah.
Seven.
Okay.
Choose your acronym of the day of
Fair
which
enough.
ones you want to fit in. Essentially,
Fair enough.
how did we get Nvidia in when it wasn't in before? How did we get
Right.
Netflix in when it wasn't in before? Right.
Right.
So, yeah. So, but of all of those big sort of Magnificent Seven or the mega caps that everybody talks about, it can be as many as 10 or 12 names if you add them
Right.
all. If you add
That's true.
Broadcom or AMD, the only one that we're in right now is Google. Google has $14 in earnings power next year. Multiply that by 20, that's $280. The stock's trading 204 today. It traded 150 just a couple of months ago. That's where we took it from a 7% position to a 15% position, because that is true growth at a reasonable price, where they were really giving it, not much of a multiple down at 150, 155 when it bottomed out a few months ago.
Well,
So,
what else? What else do you have?
yeah, so we do have the GLP-1 names in there. We think they had the 2024 that they had was brilliant. And then in 2025, honestly, both the two big ones, that'd be Lilly and Novo, have been pretty terrible. And we think that a lot of that was just money running out of healthcare, running out of those names as thematic trades. Essentially, those businesses are getting far more mature than they were a couple of years ago. They can't sell for whatever price. They can't use, whatever. But we do think that they are exactly that. They're going to continue to grow. The pill is happening. It's going to happen in 2026. And we want to own those names probably pre-pill, right? Because as the orders come in and things look really positive for the pill, we think there's a lot of opportunity. And to be honest with you, Novo trades at a really, really low valuation. Lilly trades more at a fair valuation, but both have an incredible run here, we think, going forward into 2026.
What is your stop loss situation like?
Well, we'll reassess what we're doing in a stock that has bad news. And if we have a new number for fair value and that doesn't give us any upside, that's where we'll sell a name and go into something else. Because obviously we'll have a list where we think there's 30 to 40% upside in certain names if they can revalue. And if something like a Deckers, right, which we owned a little bit of, right? So if Haugen numbers come in low and we think, oh, this stock really doesn't have the earnings power we thought it was, or it doesn't have the growth rate that we thought it was going to have, we'll just sell that and buy something else on the list, essentially. So it really depends on where our price target moves when real things come out.
Okay. Awesome. Rob Haugen is the CIO of River One Asset Management, RVER, right? That was the ticker. And
That's the
like
ticker.
I said, I do think we should probably talk to more. We love talking to ETF people on the show because the strategies are, diverse. I mentioned we're trying to diversify away from the passive nature of sort of all of our lives here. And I think ETF's the greatest thing since sliced bread, and there's a gajillion of them out there, and a lot of them are doing cool things, and you can do some really interesting stuff in an ETF wrapper, right? Whether it's active management, or I mentioned the buffer, defined outcome, whatever you want to call it. We are definitely living in a bull market for ETFs as a whole. I guess the last thing, and then I'll let you go, is like, what is the biggest challenge from an ETF standpoint? What is the biggest challenge of just like operating an ETF in this ETF environment?
Yeah, so I think 2,400 ETFs started in the last year or something, number like that. We started one of them. I would love to get those people to stop starting ETFs, right? Because we are absolutely flooding the market with them. I would say that when you're starting from zero like we were, there's a compliance pool that you're jumping into here that if you weren't already in is a new world, right? And so I would say that's the biggest challenge, and that it has to do with just filling out forms and making sure that all your I's are dotted and T's are crossed, essentially. That is a world of, if you are thinking about starting an ETF, that you have to be ready for, because that is the downside to this business, right? Is that it is highly regulated. It requires hundreds of thousands of dollars of back stuff that needs to be created, back office that needs to be created. And we're fortunate enough to be able to do that, but that was probably the hardest piece of it, is just getting through all that, learning all that, and learning the ins and outs of making sure that your DDQ or whatever it is that they need that day is done on time and done correctly.
Yeah. Did you hit 2,400 in the last year? Is that what
I think that's what I heard. Yeah.
Oh my
and that's
gosh.
just a lot. That there's only so much AUM to go around. There's now
there's only so much money out
2,400
there, right? I mean, yeah. and a lot of it is tied up in other asset classes or passive strategies. It's like, there's only
Yes.
so many.
So we might add 300 new companies via IPO, where we're adding 2,400 ETFs. Those are just wrappers over the original company. So we can't create wrapper over wrapper over wrapper without creating the original companies that we're actually bidding on, buying on the IPO market and the all of that's coming to fruition.
I think I know what you're going to say, or at least I know what my opinion is. But is there an index fund driven passive bubble?
Is there an index passive bubble? Absolutely,
Yeah.
there is. Absolutely. It isn't the funds themselves that'll feel that like they'll blow up though. Maybe some of the leveraged funds. I mean, those are things that are have a tendency to blow up on the downside. But spiders will never blow up and Qs will never blow up. But what they are blowing up is the underlying assets underneath them, right? Like we said, the Fangman or the Mag 7 or whatever you want to call it this week, most of them are very, very overpriced given their growth rate. I'll give you the biggest example. Apple has been trading at a 30 PE despite a 4% top line growth rate. There is no chance you would pay 30 PE for any 4% top line grower if it were a mid cap or if it were a small cap. The passive investing is blowing up that top side of the market. You are probably paying the wrong price for a lot of these mega caps, not all of them, but many of them. And that is essentially, once that trade shifts, that's where your portfolio will underperform an active manager.
There's a whole can of worms here. I don't know. We don't have time to get into all of that, but it's a very interesting dynamic between the passive flows and the impact they're having on markets and the rules that these fund companies have to create to sort of counteract that. It's a can of worms, like I said. So, Rob, thank you so much for joining us today. This was great, and good luck in the ETF Terradome.
Great to be here, Spencer. Thank you.
All right. Guys, I love ETFs. Have I mentioned that? I freaking love ETFs. I think they are the greatest invention in the history of capital markets and the history of investing. And I've read books on ETFs. If you haven't read Trillions, you should read Trillions. By Eric Book? It's a great book. Yeah.
Really? You've always pounded the table about how we should be doing more things with ETFs and things like that. And I've agreed with you. I'm with you. I'm with you.
I just think that they're great tools, right? Yeah. It's sort of the best of both worlds. You can do anything within an ETF strategy, an ETF wrapper, but it's super tax efficient, right? It's usually pretty cheap, right? The spreads are usually pretty good, and they're in a fee war. I mean, the fees are coming down all the time. It's never been easier. Right?
It's another great example. When people talk about, like cryptocurrencies, and there's a lot of shitty cryptos and all this stuff, and there's some good ones. Same thing with ETFs. There's a lot of just bad ETFs that are going to go to zero. They get delisted all the time.
Yeah, that's
and
true.
They're good ones.
And also, most people are not like you, and are not like Steve, and I think they're more like me. They're not gonna go chart by chart and find the winners and the losers. I don't got time. Nobody got time for that.
Can we do that? Because I got a couple here that I wanted to show.
I just give me a group. I'll buy the group. I'll be done.
Here's a group for you.
I'll wash my hands.
Throw up slide 2, 3,
I'll go
4.
for a walk with Dr. Phil.
There's the group. Here's 30 stocks.
Yeah.
Highest levels ever there, Spencer Israel. You got enough data here to suit your needs here. Dow Jones Industrial Average, all-time highs. Look,
I don't know how to interpret this because
go to the next one. Now here's 500 of them. Go to the next one there.
Next slide. There we go. Yeah.
We go. So here's 500 of them. Is this a good group? 500 of them?
Your all-time highs in the Dow Jones, that doesn't impress me, right?
It does not, but this one does.
Yeah, sure.
Okay, how about 100? How about 100 in the NASDAQ?
Yeah.
How about that one?
Yeah, it's all
Does
good.
that impress you? All right, now here's the question. Like, all this is great. Now go to the next one there. So here's your transports. So this goes back, also, 100 years. Hasn't gone anywhere. When moon, as the kids say, when moon, and then here's the best one of all of them, and then we'll bring it all back full circle. And there it is, Spencer. Give it to him. Give it to him, Fonz.
Chart on. There we go. Yeah.
There it is. Is that not the best one?
This is in the transportation, right?
Uber
Yeah.
added to the Dow Jones Transportation Average 18 months ago.
And look, this really gets at, like, this is a core issue, if there is one, of these large passive ETFs, is that they are in a way subjective, because the committees at these companies will decide and change the rules, sort of when they need to, and that's just sort of the way that's the way it is, right? So if the Dow Jones committee decides to kick Uber out, Uber is not a transport stock, right? I mean, like, it just is. It is what it is.
But I think that the strength, they're coming from Uber and Ryder, and the railroads look pretty good. Look at CSX, look at Norfolk Southern, look at Union Pacific. Those things look pretty good. Look at these huge bases in Kirby, FedEx, big bases, Expeditors. These are all transportation stocks. Spencer Israel, are you impressed that I know all these transportation stocks?
Well, there's not that many of them to know. There's like 5. You just named all of them.
You got United Airlines and Delta pushing up against new all-time highs. These are 2 of the worst companies in the history of human civilization, both pushing up against new all-time highs. I mean, how bad could things be?
JC, do you know what the new ticker for Spirit Airlines is? It's not
I couldn't tell you what the last ticker symbol was. Wasn't it like free or safe or something?
It was saved. Do you know what the new one
not
is?
safe, save.
Yeah. The new one is Fly, FLYY.
That's not a bad ticker symbol, actually. That's pretty good.
Yeah,
that's pretty good. Fly with 2 Ys. I like it.
All right, this time next week, we're going to have Dr. Phil his own bumper. We don't have it done today, sadly, but we got Phil in the house. So I'm just going to screw the bumper. We're just going to bring him out. Just cold turkey.
Cold
open.
Phil.
What's up, fellas? Hey, you pay 0.03% for the Vanguard S&P 500 fund. Expense ratio 30 cents.
What a time to be alive!
Dude, you could buy the 500 best stocks, give or take, in the U.S. of A. for,
I love it,
0.03% expense. It's practically, that is practically nothing.
What is that?
That is like
$3 for every 1,000. Is that what that is? Yeah,
30 cents for every 1,000.
30 cents for every 1,000.
That's a great strategy. One strategy that I personally incorporate. It's part of having multiple strategies. The S&P 500 is the greatest momentum strategy ever. Why? Because it buys more of the best stocks and kicks out the worst stocks. And so if you put the same amount of money in the S&P 500 every single month, you're going to be buying the highs, but you're also going to be buying the lows and everything in the middle. And that compounding is off the charts. And I'll tell you one other thing. If the S&P 500 is down 8% in a quarter or 8% in a month, you set your, however your parameters are, you put twice as much that month. And the compounding, just that whip at the end, what Perlman is saying, spot on, Pearl Dog.
And I'll tell you something else too. Anybody out there who has an advisor at one of the large banks, take a look at what you got, because those guys, I've been doing some work for some friends and relatives where I'm just taking a look at their accounts and what they're getting charged and what the expenses are. And, they have they have these old mutual funds that underperform, overcharge, and then they have their expenses on top of that, and they're trading in and out of stocks like they're our boy Kenny Glick, and they don't care about taxes. I am repulsed by what I've been seeing, and these people work for the large banks. They have titles, they have letters after their names, and they claim to be a fiduciary acting in the best interest of these people that I know, who are friends and family people. I'm truly repulsed. Like, take a look. And on top of that, this is why I came on today to say this: you have your health and you have your wealth. You are an adult. It's your responsibility to take care of those 2 things. Nobody else. It's not Kennedy, the new health czar of the United States. Nothing against him, but it's not up to him, and it's not up to your trainer at the gym. It's not up to anybody else. It's not up to the pretty lady on the YouTube who does your cycling or whatever. It's up to you to take care of yourself, and it's up to you to take care of your money. There's my rant for the day.
Yoga with Adrian.
Yoga with Adrian. She's great, but it's not up to her to do the yoga. It's up to you to get on there and
Adrian.
do it.
Is it Yoga by Adrian?
Yoga by Adrian. She's got a little dog there.
Yeah.
She's got a little dog sitting over there, very zen. Do dogs have zen nature? Yes, I believe they do.
So it's not up to her, but she can help you.
She's great. She's lovely. She's patient. She's she has the beginner videos. She has the short ones, the long ones. She's incredible.
Yeah.
But it's not up to her.
No, you know what I like about Yoga by Adrian? She does the there's like a whole segment about her. No, she does like yoga for cyclists, yoga for runners, yoga for people who sit at their office a lot, yoga for they have like yoga for everything. It's great. It's fascinating.
Unbelievable. Yoga for beginners, short ones, long ones, different flows. Unbelievable.
She's step up your yoga game, Spencer. Spencer does no yoga.
No, but I'm learning about her as we speak. So I've never heard of her until just now.
Dude, yoga's like the best thing ever, dude.
Just as long as it's not hot yoga. Like I don't.
No, it's not necessary, dude. You can have perfectly mild temperatured yoga.
Okay.
Right, Perlman?
Yes. You could put the air conditioner on if you want.
I own a yoga.
ATX machine. Yeah. Is she cool? You went to school with her? He said he went to school with Adrian.
Really?
Yeah. That's wild.
Where does she live? I don't even know where she's from. She's like in Montana or something like that.
She's a big star. She's the real deal.
Yo,
big
Adrian. Star. Is that what you said? Yo, Adrian.
Adrian.
Anyway, all right. Oh, it's 9:37. Hey, let's get out of here. All right, we got trades to make.
Bro, that was lovely, my friend. That was lovely.
The ETF game, Vanguard ETFs. You get them unbelievably low cost, 30 cents on $1,000 for a year, and you could build your portfolio with a few ETFs. So there's, active money. You got your account. You're trading. You got breakout multiplier, or you're trading with Kenny, or you got all-star charts, and you're working with those guys, and you're growing your account. It's fantastic. But then over here, you have your 401k, you have your IRA, you have money you're putting away for the long term, and you want to deal with that soundly like an adult. And you get some of these good low-cost ETFs. You put the money in. You keep putting the money in. The market gets crushed. You go out and buy Nick's book. Just keep buying. Buy that book and read it. I can't tell you how important it is. And know what you got. Okay, I've said enough. All right. Good.
We got a busy day today on the channel. We got Kenny Glick going live. And we got Sean going live first at 11. What are my options? This is new time. Tuesdays at 11 o'clock. Then Kenny at noon. Jeff Mackey at 1. A lot going on today. Thank you, Phil. Thank you, Rob. Thank you, Kenny. Thank you, chat. No Ricksta, man. We don't got time for recess, man. We got to go. We got things to do.
She's from Austin. She's Austin.
Nice. We got things to do.
That's your homework. Awesome. Everybody go do one yoga with Adrian session.
Go do some yoga.
That's the homework. That's the reason.
He's got like a 15-minute one where you just, touch
cat and dog. I only know cat, dog, and pigeon.
She is the Brian Shannon of yoga.
Right? She is.
All right.
Exactly.
I'm going to do some pigeon pose. I'll see you guys. All right. Go make some money.
Adios.
Run it. I can't take no loss. I don't even know what it costs.